Hey folks, welcome back to this edition of Ben's Bits. We're continuing discussing the topic of retirement and how the investment vehicles you choose have a direct impact on your portfolio. Now, today I just wanted to take a moment and debate a few of the thoughts on the differences between mutual funds and notes with respect to retirement accounts and how they drastically affect your retirement goals. We've found that most people aren't aware that one of the biggest issues with mutual funds is the fact that you're putting up 100% of the money and taking 100% of the risk for, say, around 30% of the return. Now, please feel free to do the math for yourselves that I just mentioned, and if you have mutual funds as part of your investment strategy, to see a more calculated figure of your own portfolio. Now, to clarify, we're just talking about mutual funds. Of course, there are other strategies that have higher returns to them, but they typically come with greater risk and more volatility and exposure in the market, which of course comes with more stress for those who are more dependent on the result or have a time issue, meaning that retirement is just over the horizon. The biggest issue that isn't discussed when mutual funds are employed is that there's nothing to fall back on in the event of a catastrophic event or a market decline. If something goes wrong, fund managers still get their cut, and you're stuck with a big loss because, again, you're putting up 100% of the capital and taking on 100% of the risk. That's why you typically hear fund managers say, this is a long-term strategy, or if there's a market decline, just hold tight because the market will rebound. Now, here, we love to be very optimistic and we prepare and expect for the best because there's a bit of truth in the expression, you attract what you expect. However, we also need to prepare for contingencies that could help mitigate losses as a backup plan because that's just smart business practice. Now, incidentally, that's why we concentrate on notes and are more note-centric because we have a fail-safe in the asset itself. If something goes awry and we hear danger, Will Robinson, well, at least we have a tangible asset that helps stop that catastrophe from becoming something that you can't recover from. And in some instances, we can end up helping a lot of people out of a really bad situation. Now, I don't want to depress you if you have capital deployed in mutual funds. The point of today's bit is to reinforce the point we mentioned at the top of this video. When you're in those type of investments, remember that it's only around 1/3 of fund managers surpass the benchmark of the market on average over the last 15 years. We've spoken on this topic before, and that's why we're so passionate about getting this message out to you. Life is expensive, and most of us want to leave a legacy, a lasting legacy on top of that of retirement as well. So that's why it's important to be actively engaged with assessing continually with your retirement. And that's the only way to accomplish your retirement goals. But more importantly, you'll want to be able to live through your retirement years without having to sacrifice to do so, as we all do. So, just a few simple words on the subject. That's it for this edition of Ben's Bits. And as always, thanks for watching, and we'll see you next time.